to another Straight Up Tuesday tip. I'm 𝗤𝘃𝗀𝗀𝗃. With me as always is Mark Ainley. And with us, we have two guests on the Tuesday tip. I think that's a new one for us, Mark. We have Danny Mantis and Matt Helper, both from 𝗤𝘃𝗲 Group. For those who don't know, 𝗤𝘃𝗲 Group is our exclusive sponsor in the multifamily space. And they are also Chicago's mid-market leading multifamily brokerage. I knew I'd stumbled that, but I got through it. So both Danny and Matt are highly involved every day, talking to owners, talking to buyers, talking to sellers. So we wanted to talk today a little bit about inflation. It's been a huge buzzword since rates have been so low from the end of 2021, leading to Q1 of 2022 as we're recording this. Now, we want to get your opinion on what are you seeing with inflation? Will we get a rise in rent rolls because of that? Are you seeing more and more buyers interested in the commercial space, or I should say the multifamily space, because of inflation and using it as a hedge? And does that differ from all across different asset classes? So I just asked you about 17 questions in one there. I'm going to turn it over to Danny to at least kick us off and what he's seen in the market.
Yeah. So thanks for having us, Tom and Mark. I think inflation has been something that a lot of people have been speculating about before it was an issue. I'm thinking back to early 2021 when there was just record numbers of government stimulus being put into the economy. People were talking about the impact that was going to have on inflation. I think we're kind of seeing that play out in the macro economy right now. And I do think that it's going to have its impact on multifamily real estate. Obviously, the Fed is tightening rates right now, which is going to have an impact on debt service. But we're also seeing that offset largely by increases in rents really throughout Chicagoland.
Matt, are you seeing the same thing?
So landlords that I've talked to, and I talked to in virtually every submarket in Chicago, had really good December and January rental season leasing, renting quickly, renting for, in some cases, over market. In every, whether it was luxury, whether it was workforce housing, city, suburbs, doesn't matter where. I think that's because of inflation, at least partly attributed to inflation. So yes.
Okay. And do you guys feel that someone in the luxury space, the A-class space, will benefit more from inflation than someone in the workforce housing provider?
Do you mean the owner of the building, or
the owner? Yes.
So I think the larger landlords, inflation is also, utility costs have gone up. That's part of it as well. So if you're a smaller landlord that might not have a contract with your utility, you might be seeing the costs to your building or buildings rising quicker. If you are I talked to someone this morning, they are hesitant to raise rents much more than where they are because of where they own properties. Their tenants are lower income, and they're concerned about the cost of bacon and just consumer goods. And if they raise their rents, will they be able to do that? So I think there's those factors you need to consider.
Are you seeing anything around subsidies raising their rents or raising those standards as far as that goes for Section 8 or HACC to kind of keep up with inflation?
So that's actually an interesting question. I was talking to someone last week who was actually really frustrated about this exact example. They could not get subsidized tenants or the organization paying the subsidy to increase the rental amount drastically to keep up with the pace of inflation for existing tenants. So instead, what they had to do is say, we're not going to renew that contract. That tenant would move out, go and get a higher subsidy for a new apartment, and then get a new subsidized tenant in, which, frankly, makes no sense. But that's, it's an anecdote, but that's one real world example of a frustration on that point.
Yeah. And you guys are putting together offer memorandums all the time. Are you getting more aggressive in what you think rents will increase over the years? right? Are you starting to see like, hey, there's gonna be no problem bumping this, as opposed to 2 or 3 years ago where it might have been a little more conservative in that estimate?
So when we're putting together,
I want the real answer, not the broker answer.
right? So when we're so depending on who the broker is, so this is, you see the pro forma numbers. Do you flat out ignore them? Are these fancy?
Mm-hmm.
The approach Danny and I try to take is, can we justify them? We're not necessarily saying you're going to flip the switch and after year one, this is what will be the rents. We're working on a deal that we got coming out soon. One of the rents, as an example, is at $995. It's much higher than the other rents. Him and I were going back and forth about what we could actually justify as a pro forma rent, because that rent seemed unusually high. The short of it was that unit got rented in the time I was talking about earlier or late in 2021, where it was a bit of an anomaly that people were just renting and getting them rented quicker. So I think what we're going to wind up doing is use a 970 as a pro forma stabilized asset, even though it is lower than what is currently in place in one unit, relatively small building. But I guess the approach we take is, can we justify it? When we're out at the building and people are making fun of us for making up numbers, can we at least justify it as this is where we came to this number?
I like that answer.
So along those same lines, do you see cap rates compressing even more or faster, I guess, based on rents being almost add value in some of these projections?
I think there's some nuance to that, though, because the question is also, are cap rates going to continue to compress? And I don't know that they are. My personal opinion, and again, this is not probably the right brokerage answer, but I think my prediction is that cap rates are going to flatline. Yes, rents are going up, but I mean, the Fed is talking about raising rates as much as 9 times in some people's opinion. So I think there's just kind of a hold steady approach for cap rates and the cap rates that people are using to justify their investment decisions.
So the other thing I like about that answer, Danny, you can't be too far off. Take the middle road there. You'll look pretty good.
Yeah.
So I guess one more on inflation. Are you guys getting any more than usual? The out of state, just, I have a ton of money, I want to park it somewhere, right? I need to put my money somewhere, put it to work, and this is my hedge against inflation. We know that there's those type of buyers out there. Are you seeing an influx of it?
My answer to the question would be that I don't know that we're seeing at least in my perspective, more out of state investors investing directly into ownership of real estate. But instead, I think what I'm seeing is more syndicators come through and being that intermediary for investing in real estate. And I think that is actually gaining a lot of traction. So the answer is nuanced, but kind of, yes.
What I was going to say is, I don't know if the out of state investors are coming now specifically because of inflation, but Danny's right. It depends if their equity is coming from high net worth investors that have all sorts of different reasons for investing in direct real estate. That could be one of them, but there is no shortage of out of state investors in Illinois for multifamily in buildings as small as 6 units.
Got it. Yeah, I lost out on a 12 unit to an out of state guy. I was like, man, I didn't know you played the small.
We just sold a 5 unit building to an out of state investor.
Wow, man, lots to digest there. And then we'll run this in a year from now to see how far off all of us were.
See how wrong we were.
Mark, anything to add?
I got nothing.
All right, we got a Chicago fact, and we'll give you guys a chance. Mark gets first crack at this, but then you guys get a chance as well. And then obviously our friends from Kaiser here, will link to them in the show notes if anyone wants to learn more about the opportunities they have, properties they have for sale under contract right now. All right, but Mark, your question. Completed in 1967, this structure is famous in Chicago for 2 towers that many say resemble giant corn cobs. What is the name of the structure?
Marina Towers, Marina City.
He got it. You didn't even give our guests a chance there. Nice work. No multiple choice.
Well, do you know this though? I don't know if it's one of the books that you and me both read, but that was originally built as like low income housing.
Yeah.
Those buildings, like, and then that, because that area wasn't as nice as it is today. So that's kind of a fun fact twist.
That's crazy. Right on the river there.
I know, right? But you look at that river 100 years ago, how nasty it was because of industrial waste. Like, so the rivers came a long way.
Yeah, the river is super clean now, let me tell you.
Matt, Danny, thank you very much for coming on here. Listeners, check out all of our local networking opportunities. We just recently updated it. Some things are still on Zoom. So if you're not in the area, you could easily check out these networking events. And then hopefully soon we'll be back in person where we can do this live. So guys, thank you very much. And listeners, we'll see you Thursday.
Thank you.
Awesome. Thanks all.